When China attempts to rein in its bloating financial landscape, investors should brace themselves for a risk of a fallout. Trying to deleverage the Chinese economy is akin to tapping on your brakes on an icy road. Tap too hard and you could easily lose control. At Spectrum, we see the risk of an unintended slowing of China's economy has risen. At the same time, credit spreads, or compensation for taking corporate bond risk in Australia, has fallen. Given the combination of these two things, we believe at Spectrum it's best to turn that risk-reward dial towards conservative mode until factors change. The Chinese economy cannot continue to grow through raising credit at this current pace without posing excessive risks. The Chinese authorities know this. Indeed, the President noted this as a top priority for 2017 to curtail financial risk. Now, acknowledging is a start. The hard part's to do it. And as you'll see on this following graph, when you look at other countries that had their credit surges, when they've reversed, they've also coincided with a financial calamity. You see here in Japan in the 1980s, you see Thailand in the 1990s, you'll see Spain and the US when they're taming their property cycles in the 2000s, all came with a sharp slowdown. See, China's surging credit, well, what happens when the government starts to tame that surging credit, we'll only see over time. China faces another challenge, its demographics. You see on this following graph, the line here, you'll see China's working age population is going to shrink rapidly over the coming years. This will create a big headwind to its economy. But what worries us at Spectrum even more is you look at the comparison between it and Japan. Now, Japan had the same sort of problem starting in the late 1980s. This also coincided with a deleveraging of Japan's excessive corporate leverage as well. And unfortunately, Japan then entered in what was called the lost decade, where they had over 10 years of stagnant economic growth. The counter-argument to this is that the Chinese government has the tools, capacity and power to actually help implement a transition from a credit-fueled economy into one less dependent on loan growth. The other argument, of course, is Japan in the late 1980s was a far wealthier country than China on a per capita basis, indicating China has much more potential to grow. And of course, China is looking to engage in large infrastructure projects, that is, linking China to Europe through a series of transport networks. But these are all relevant factors, and we believe that they do mitigate the risk, but do not eliminate the risk of what happens in a deleveraging of an over-leveraged economy. More to the point, we don't see that investors are getting well rewarded for the risks of a China slowdown. As you'll see on this following graphs, the credit spread, or the additional margin you get over the government bond yields in Australia, is down close to its post-GFC lows. Given this and the risks of our largest trading partner, we believe at Spectrum it's best to keep the portfolio in a conservative mode. For more information on this topic or on Spectrum itself, please go to our website www.spectruminvest.com.au.